In March 2008, one of Wall Street's most powerful banks collapsed in 72 hours. Nobody saw it coming, and it was only the beginning. Bear Stearns had survived for 85 years. The Great Depression, World War II, Black Monday, the dot-com crash, every financial crisis America had ever faced. Bear Stearns survived them all. Then, in March 2008, in the space of 72 hours, it was gone. Stock price from $66 to $2. 85 years of history wiped out in 3 days. And what happened to Bear Stearns was not just a corporate collapse. It was the first domino falling, the warning shot that nobody listened to. 6 months before Lehman Brothers, 6 months before the entire global financial system almost ended. This is the story of Bear Stearns and the collapse that should have changed everything, but didn't. To understand Bear Stearns, you have to understand what it meant to Wall Street. Bear Stearns was founded in 1923. It was not the flashiest bank on Wall Street. It was not the most prestigious, but it was one of the toughest. Bear Stearns had a culture unlike any other investment bank in America. A scrappy, aggressive, take-no-prisoners culture that prided itself on surviving anything. During the Great Depression, while other banks collapsed around it, Bear Stearns survived. During Black Monday in 1987, when the stock market dropped 23% in a single day, Bear Stearns survived. The firm had a saying: every employee was a producer. Nobody coasted, nobody hid. Everyone contributed, or they were gone. It was the kind of culture that created extraordinary loyalty and extraordinary blind spots. By the mid-2000s, Bear Stearns had gone all in on something that would eventually destroy it: mortgage-backed securities. These were financial instruments created from bundling thousands of home mortgages together. The theory was simple: home prices always go up. Homeowners always pay their mortgages. So bundles of mortgages are safe investments. They generate steady income. They are backed by real assets. They are as close to risk-free as anything on Wall Street. Or so everyone believed. Bear Stearns built an enormous business around these products. They created hedge funds that invested heavily in mortgage-backed securities. They sold these products to investors around the world. They made billions in fees and profits, and they leveraged themselves to the absolute maximum to do it. For every $1 of actual capital, Bear Stearns was borrowing $30 to invest. 30-to-1 leverage. It was an extraordinary bet on one thing: that the American housing market would never collapse. But in 2006, cracks started appearing in the American housing market. Home prices that had been climbing for years started leveling off, then falling. Subprime mortgage borrowers, people who had been given loans they could never realistically repay, started defaulting. First in trickles, then in floods. The mortgage-backed securities that Bear Stearns had built its empire on started losing value. Fast. In June 2007, two of Bear Stearns' hedge funds, the High-Grade Structured Credit Fund and the High-Grade Structured Credit Enhanced Leverage Fund, started reporting massive losses. The funds had billions of dollars invested in subprime mortgage securities, and those securities were collapsing in value. Investors panicked and demanded their money back. The hedge funds could not pay. Bear Stearns was forced to bail out one of the funds with $3.2 billion of its own money. The other fund was left to die. It was a catastrophic signal. But Bear Stearns' leadership insisted everything was under control. CEO James Kane told investors the firm was strong. The hedge fund losses were contained. There was nothing to worry about. He was wrong. By early 2008, the subprime mortgage crisis was spreading across Wall Street. Banks were reporting massive losses. The credit markets were freezing. Nobody trusted anybody. And rumors started swirling about Bear Stearns. On March 10, 2008, rumors began circulating that Bear Stearns was facing a liquidity crisis, that the firm did not have enough cash to meet its obligations. Bear Stearns denied the rumors furiously. CEO Alan Schwartz went on CNBC to reassure investors. He told the world Bear Stearns was fine. Its balance sheet was strong. Its liquidity was strong. There was absolutely no problem. That interview aired on a Wednesday. By Friday, Bear Stearns was dead. Here is what happened in those 72 hours. When Schwartz went on CNBC to deny the rumors, it had the opposite effect. Investors and counterparties who saw the interview did not feel reassured. They felt terrified. If the CEO of Bear Stearns had to go on television to deny a liquidity crisis, there must be a liquidity crisis. The calls started coming in immediately. Counterparties who had overnight lending arrangements with Bear Stearns started pulling their money. Hedge funds that had accounts at Bear Stearns started withdrawing their assets. Investors started dumping Bear Stearns stock. It was a classic bank run, but at Wall Street speed. Within 48 hours, Bear Stearns went from $17 billion in liquid assets to almost nothing. $17 billion gone in 2 days. Not from losses, from panic. Pure, unstoppable, self-fulfilling panic. On Thursday, March 13th, Bear Stearns CEO Alan Schwartz called the Federal Reserve. The message was simple. Bear Stearns was going to run out of money by morning. If the Federal Reserve did not intervene, Bear Stearns would be unable to open for business on Friday. The Federal Reserve faced a terrifying choice. Let Bear Stearns fail and risk triggering a broader financial collapse, or bail it out and set a precedent that would define the entire financial crisis. They chose to intervene. The Federal Reserve arranged emergency financing through JPMorgan Chase, enough to keep Bear Stearns alive through the weekend. But it was not a rescue. It was a temporary life support measure to give the government time to find a buyer. Over the weekend of March 15th and 16th, Treasury Secretary Hank Paulson and Federal Reserve Chairman Ben Bernanke worked around the clock. They needed to find a buyer for Bear Stearns before Asian markets opened on Monday morning. If they did not, the collapse of Bear Stearns would trigger a global financial panic. The buyer they found was JPMorgan Chase, and the deal they structured was stunning. JPMorgan agreed to buy Bear Stearns for $2 per share. $2. A year earlier, Bear Stearns stock had been trading at $170 per share. Employees who had spent their entire careers at Bear Stearns and had their retirement savings in company stock lost almost everything overnight. The Federal Reserve agreed to guarantee $29 billion of Bear Stearns' toxic assets to make the deal happen. $29 billion of taxpayer money to clean up the mess that Bear Stearns' reckless bets had created. The deal was announced Sunday morning, and Wall Street woke up to a new reality. If Bear Stearns could collapse in 72 hours, anyone could. The Bear Stearns collapse sent shockwave through Wall Street. Other banks started examining their own exposure to subprime mortgage securities. The credit markets froze even tighter. Confidence in the entire financial system was shaken. But here is what is most extraordinary about the Bear Stearns story. The warning signs were all there. The hedge fund collapses in 2007 had exposed the problem clearly. The leverage ratios were insane, 30-1. The exposure to subprime mortgages was catastrophic. And yet, nobody stopped it. Regulators did not intervene. Other banks did not reduce their own exposure. Wall Street assumed Bear Stearns was an isolated case, a one-off failure that would not spread. They were catastrophically wrong. 6 months later, Lehman Brothers collapsed, and the entire global financial system came within days of complete destruction. Bear Stearns was the warning, and nobody listened. What happened to the people at the top? CEO James Kane, who had been playing golf and bridge tournaments while the hedge funds collapsed in 2007, sold his Bear Stearns stock for $61 million before the collapse. CEO Alan Schwartz, who told the world everything was fine 3 days before the firm died, went on to become a senior executive at other financial institutions. The executives who built the leverage to 30-1 and bet everything on subprime mortgages walked away with their bonuses intact. The employees who had their retirement savings in Bear Stearns stock lost everything. The taxpayers who backed $29 billion in toxic assets through the Federal Reserve never got a say in the matter. Bear Stearns was the first warning shot of the 2008 financial crisis, the first proof that the housing bubble had burst, that the mortgage-backed securities were worthless, that the leverage was unsustainable, that the entire system was built on a lie. But Wall Street did not listen, and 6 months later, Lehman Brothers fell, and the world changed forever. This is Boardroom Fallout, where billion-dollar lies come to light. Next up, AIG, the insurance giant that insured all the toxic bets on Wall Street and nearly took down the entire global economy when it could not pay them. Subscribe now so you don't miss it.